crossing county lines just to make my name in the city. Took everything, put it on the line, cause I never break or back down. One shot is do or die, and the odds ain't looking too pretty. But I got the feeling it's my time. I know I'm taking it now.
Good morning and welcome to the Retirement Learning Lab Live. My name is Van Richards, and today we're going to be talking about active and passive investments and index investing. The idea that we run across today, or that we do today with you, is our objective is to help you learn how to retire without running out of money. And this is what we're going to be talking about today specifically. Take a look at this and I think you'll understand where we're going to start. Active and passive investments, or index investing, is a conversation that people have been having for a really long time. Vanguard was one of the first companies that started the idea of the index fund, and there's a lot of discussion over which is actually better, a passive fund like an index fund or an actively managed fund that actually has a portfolio manager that buys and sells different types of investments. Before we begin into that particular topic, I want to take care of a couple of different things. First off, if you're listening to this live on Tuesday, welcome. You can actually be part of the program today. If you have a question or you have a comment, make sure that you enter it into the comment section. If you're listening on YouTube Live, why not subscribe to that so that you can get a notification on a weekly basis of when the live stream is available. And also, I post a lot of bonus content out there that will help you with investing and will help you also with retirement as well. If you're listening on YouTube, make sure that you hit the subscribe button. If you're listening onto one of the platforms that I have on Facebook, make sure that you like that particular page and you can enter in comments when you have questions. Also, if you're listening on Periscope or on Twitter, you can enter in comments there too. Now, if you're listening to this later on in the week in a replay, you can ask questions then too. If we talk about a particular subject and you have a comment or you have a question, enter it in. I monitor the different platforms as the week goes by. So if you have a question and you'd like to get it answered, make sure that you just enter it in and we'll get back with you. And if it's a really good question, it might be in next week's live stream. And if it's a really good question, I might make a separate video on it, as I've done sometimes before. If you want to learn more about some of the different videos that we've produced on different retirement subjects or investment subjects, the best place to look is go over to YouTube, because there's a wide variety of things on our website, on our channel there. Now, we don't have quite enough subscribers to our page yet so that we've got a personalized URL. So the best way to get to it is to go to my website, which is richardsfinancialplanning.com. If you go all the way down to the bottom, you'll see down in the bottom, we call it the junk drawer, where all the other information is. If you look down there, you'll see the YouTube button. Click on that, and that'll take you directly over to it, rather than me trying to spout off a URL that's this long. Okay, so let's get into the topic today that we're talking about, active versus passive investment management, and we're going to have a bonus conversation about direct investing also. So let's take a look at what we're talking about. Okay, so that we have, let me back up here just a quick minute. Thinking back to that one that was previous about transparency, I want to make sure that you understand that we have a common understanding that the information that I'm giving to you today is education. It's not advice. If you want direct advice, it's more than available to you. All you need to do is go over to my website at richardsfinancialplanning.com, and you can sign up for a time to talk. It's free. It doesn't cost you a penny. We'll spend a little time talking about your particular situation and how some of the information that we have might apply to it, or answer questions about your retirement that we haven't even talked about today or in other particular videos. The idea of active versus passive management, I want to make sure that we have an understanding of what these three topics are. That is active management, passive management, and direct indexing. So let me go through just a little bit of information so that we're both on the same page. When we're talking about active management, what we're talking about is where there are actually people that are involved. There's portfolio managers, there's a team of analysts, and they're discussing about and analyzing which stocks or bonds or other different types of securities that are involved that they should put in or take out of that particular portfolio. Those are active managed funds. Now, a lot of people might think that the reason that active management occurs is the objective of the active manager is going to be to outperform the index. And that's where a lot of the controversy comes in, because some people think that active management is worthless because it can't outperform an index fund. Perhaps that might be true. I don't know. We'll talk about that in just a little bit. But there are circumstances where active management, I can't say it, active managers do excel better. And you might think of certain circumstances where an active manager may be focusing on a particular sector or a particular direction, or they may be managing the fund for risk, as in a target fund or a balanced fund, or they may be managing the fund with the idea of principle-based investing, as in ESG or environmental, social, and governance, or in biblical responsible investing. There's a lot of different reasons that people go into active managed funds, and we'll talk about in a moment some of the best reasons to go into those types of funds and some of the reasons why passive funds will excel at that. Now, the idea of passive funds, though, is kind of confusing, because passive funds that term does not mean that there's no activity that occurs. If you have a passive fund, there's actually a lot of activity that can occur in a particular year. Usually with a passive fund, it's matched with a particular index. An index is going to be a sector of the economy, and that particular index may focus on that. It might be large cap stock funds. It may be small cap stock funds. There's a wide variety that's associated with it. I want to take an example of a small cap index. That's going to be the Russell 2000 index. And I want to show you what happened over a period of a year in 2017. If you think that buying an index fund is just a buy and hold strategy, you're about to be very, very surprised. Let's take a look at this. I want to make this a little bit bigger so that you can see exactly what I'm talking about. In 2017, the Russell 2000 did this. It had 228 companies that were added to that index. It had 137 companies that left the index. It had 42 companies that entered the index by moving from the large cap Russell index, which is the large cap funds. It had 115 companies that moved up from the Russell microcap index. 31 companies exited by moving up to the Russell 1000, and 26 companies just left that particular index. Now, why is this a particular problem? Let's talk about that just for a second. The reason moving stocks in and out of a portfolio are, I won't say that it's bad, but it can have an adverse effect on you. And the biggest place that it can have an adverse effect on you is going to be in taxes. Every time that a stock is bought or sold, there's going to be a tax implication that's associated with that. If there is a gain on that particular stock, then it's realized in the portfolio. If there's a loss, the same thing happens. There could be a loss that's associated with it. Now, if there's a loss, you don't have to come up with more income taxes. If there's a gain, you do. Now, here's part that a lot of people get stuck in. And this year in 2020, I fear that this is going to happen to a lot of people. When stocks go up over a period of years, let's say, for example, if you held a particular stock for 5, 10, 15 years, and it had gone up over a period of time, when you sell it, if it's much higher than when you bought it, you are responsible for paying taxes on that, or a capital gain. Now, if you're inside of an ETF or a mutual fund, it doesn't matter whether it's active or whether it's passive. If that stock is sold, you're also responsible for the income taxes, the capital gains that are going to be on that particular stock, even though it's in the portfolio. Now, here's the real kicker. If you own a fund, let's say, for example, if you bought into a fund in May and they sold a stock in June that had been held for 10 years, you are still going to be responsible for a portion of the capital gains tax, even though that you've just held it for a month. Now, the thing that happens in some circumstances is you can buy in May, the fund can go down in value, so you actually have less value than you started with in May. The fund declares a capital gain because of sales of stocks that they've held for a long time, and you have a capital gain or a taxable gain that's declared, and you actually have less value than you started with. That's a problem that happens on a regular basis. That happens in index funds also through that process that we just talked about that's called reconstitution. Reconstitution is when the fund changes particular stocks for one fundamental reason or another. And it doesn't have to be that they're trying to outguess the market or to buy stocks that have particular profitability or less profitability. It's just a function of that particular index. They have stocks that go up and down. A lot of times you'll hear about the S&P 500 doing this. There will be a stock that may be added to the S&P 500 because the company's value increased to the point that it's able to be added to that index. You also hear about companies that drop in value and are taken out of the S&P 500. It's no secret that when a company is added to the S&P 500, it's going to be bought more, it's going to go up in value. And historically, when a company comes out of the S&P 500, they lose value. Now, that's not advice, that's just a historical fact when you look at it from that standpoint. If you own an index fund, you have a tax implication. If you own any type of fund, an ETF or a mutual fund, you're going to have some sort of tax implication that's associated with it. So enough about the taxes and reconstitution. We want to talk just a little bit more also so that you can get an understanding of what index funds or direct index funds are going to be able to do also. See, the idea of stocks, though, that are inside of an index fund, I kind of equated it to this. It's like sailing. If you remember the old Christopher Cross song that was called Sailing, sailing, take me away to where I always thought it could be or knew it could be. I'm not sure the exact words on that. But the idea is if you just wanted to sail, you would just get on a sailboat. It doesn't matter if you have a rudder or not. If you just wanted to sail, then you get on the sailboat and you go. That's kind of the way that it works with a index fund. You don't really have any say in the direction that you're going. You don't have any say in stocks or any securities that they're bought or sold, when it's going to happen, how it's going to happen. If you have tax implications, you just do. It's just part of the fund. Now, if you have it inside of a retirement plan, it really doesn't matter. But the idea is that if you own it individually, that you can have some tax implications that are associated with it. Direct indexing is the concept of owning the index, but you've got more control over it. You can own every single stock in that particular index. In other words, if you had the Russell 2000, you could, that's actually more than 2,000 stocks, I believe. Recently I read that it was about 2015. You could technically own every single stock in that index. Now, I don't want to be misleading, because if you are trying to mirror an index, just owning one stock of every stock in the index doesn't mean that you're going to replicate what's going on in that particular index. An example is going to be the S&P 500. In the S&P 500, you'll note that it's weighted based on the company's value, not based on the stock's value. Now, that's a difference actually in between the Dow Jones and the S&P 500. The Dow Jones is actually based on the individual company stock, and the S&P 500 is based on the total company's value or the capitalization. Now, that becomes a little bit of a problem as we look further into indexing. I want to get to this part. Part of the problem with index funds is this. If you own an S&P 500 fund now, or relatively so, the top 5 stocks of that index are all tech stocks. Apple, Microsoft, Alphabet, Amazon, and Facebook represent 17.5% of that index. And there are some people that would say, I don't really want to have that much tech stocks. And there are some people out in the advising world, in the management world, that are saying that tech stocks are growing too fast and we could have another tech bubble like in 1999. But on the other hand, you have people like Jim Cramer from Mad Money that says, that doesn't make a difference. It's not the same situation. Also, some of the writers from Morningstar also have the opinion that we're not in the same type of situation that we were back in 1999. Nevertheless, if you have an index fund, like an S&P 500 index fund, you have a large portion of your money that is devoted to tech companies. You might not want that. If you don't want that, then direct indexing will give you the control over taking some of those stocks out. It may be that you think that that might be extra risky and you don't want that. Another reason that direct indexing has a big advantage at times is going to be that you can pick when to take those particular stocks in and out. You don't have to worry about the taxes that's associated with it. But the idea is, if you're top heavy in this particular situation, a direct index strategy can allow you to own those stocks, but in a lesser degree. Another reason is that you might want to own less stocks. Let's say you work for one of these 5 companies and you have stock in your retirement plan from one of these companies. Or let's say, for example, you inherited a bunch of Apple stock from a relative, and that represents a large portion of what you have as far as your investments. You might want to diversify. So you would perhaps, in your direct indexing strategy, replicate an index except for Apple, or except for one of the 5 that's here if you already own it. That's one strategy and one usefulness to direct indexing. There's actually 4 features of direct indexing that set it apart from passive investing and set it apart from active investing. Let's take a look and see exactly what those are. We've talked about a little bit the allocation reduction. In other words, if you don't want as much of the 5 tech stocks that we just talked about, you can control that. If you want to avoid the reconstitution that we talked about earlier with the example of the Russell 2000, then you can avoid that through direct indexing. You also can use it for tax losses. Now, that's a really big deal, because if you own 2,000 stocks, I'll guarantee you, well, I can't guarantee anything, but I'll be able to bet that all 2,000 of those stocks are not going to go up. There's going to be some of them that are going to have losses. If you own an ETF or you own a mutual fund, you can't selectively sell those individual stocks. So that does create a little bit of an issue if you want to sell them to take advantage of the tax losses. Because if you sell an investment for tax losses, you're able to take that directly off of your income for income taxes. I'm not here to give you tax advice. You'll need to see a tax advisor about that. But this will help you so that you can pay less income taxes throughout the year. The 4th advantage or unique idea that's behind the direct indexing is that it allows principle-based focuses. In other words, let's say, for example, you want to own an S&P 500 fund, but you don't want to own any alcohol stocks, or you don't want to own any tobacco stocks, or you don't want to own any stocks of companies that do animal testing because you're vegan. you can do that through direct indexing. You could own the entire S&P 500, but you don't have to own those particular stocks. It's actually pretty easy to do. We overlay and take stocks out on a regular basis from direct indexing. Now, if you like the idea of direct indexing, there are three things, if I can show my hand here, there are three things that you have to be able to do. Number one is you have to have commission-free investment trades. Now, why is that important? Imagine if you wanted to have a direct index that was the Russell 2000. You can actually go out and you can buy one of every stock in the Russell 2000. It would only cost you about $15,000 to $16,000. You can own the 2000 stocks, or actually around 2015 stocks that are in the Russell 2000. But imagine if you had to pay a trade fee every time that you had to trade a stock. It would be overwhelming. If you only had $16,000 to invest and you wanted to own the entire index and you had to pay commissions, it would be worthless to do that. So the first must have for direct indexing is you have to have commission-free trading. The second thing that you have to have is you have to have fractional shares. I noticed actually yesterday that Fidelity just started doing this, and they call it a slice. You can have a slice of the stock. Well, whichever way you say it, a slice or a fraction, it's going to be that you don't have to own the whole stock to buy it. Now, that's particularly useful if you want to have like an S&P 500 fund, where you might have, if you went back and you looked at those 5 stocks, those tech stocks, if you just look at Amazon, Amazon's been hovering around $3,000 a share. Even if you had $100,000, it would be very difficult for you to get the proportionality correct for the S&P 500 with $100,000. You would need a lot more if you only had to buy full shares. But by owning partial shares, then you're able to own a part of that. You can call it either slice investing, as they call it at Fidelity, or you can call it fractional investing also. Now, the third thing that is overlooked at times is going to be tax harvesting technology. If you're going to use direct indexing as a strategy, tax harvesting technology is really, really important. Why? If you own 2,000 stocks, you need to be able to analyze which ones are going to be having losses in a particular year. And that's important so that you can take advantage of it. Remember, the idea of owning the direct index is you can determine if you're going to buy or sell particular stocks based on the tax implications that you would have, not based on some random factor that really doesn't have any rhyme or reason, let's say. Okay. So let's get into really now, I've taken a good amount of time and talked about the idea of the differences between active investing and index investing or passive investing. And we talked about direct index investing also. But let's talk about the different situations where one of these excels over top of another. Now, I know there are those of you out there that are saying, passive investing is the way to go. That's the way that I want to make sure that I'm putting my money away all the time. I just put it there and I don't really have to worry about it. I've been on a couple of different Facebook groups where people have said, I'm retired. I'm just going to buy the S&P 500 index. It's going to be okay. Well, then we have March or February of this year that occurs. And when the market drops like a stone, then you start to worry about, well, if I want to be taking income out of this particular fund, how am I going to do that? Because it's worth less than it was before. So it causes a particular problem. Now, there's some strategies around that, like bucketing or flooring. There's some different strategies that you can use to avoid those particular situations. But there are some particular funds that excel in certain situations. So let's take a look at that. This is a study that was done by a gentleman by the name of, I want to make sure I'm going to look at it here and get his name correct. His name is Alexei Pancheka. And the study that I'm referring to, you can actually, if you look at the footnotes of the blog that I wrote that's on my website, it has the link to Mr. Pancheca's or Dr. Pancheca's article that we're talking about today. Now, one of the things that Dr. Pancheca did is he looked at a large universe of actively managed funds. And what he found was that when funds have a particular focus, and he actually called it concentration, when they have a particular concentration, those funds that have a concentration do outperform index funds on a regular basis. Now, what do I mean by a concentration? I think the best example of a fund manager that uses a concentration strategy is going to be Warren Buffett. Warren Buffett right now has a large portion, and I'm not going to quote the number, but let's say that it's a large percentage of his portfolio of Berkshire Hathaway is in Apple. So he has a lot of confidence in Apple. He has a lot of concentration. And what Dr. Pancheca proved is that Warren Buffett's not the only portfolio manager that uses this strategy. He's probably the most popular because he has the largest portfolio, but he's not the only one that does it. When portfolio managers invest with their particular convictions on a regular basis, they will outperform, or historically, I won't say will because that's predicting and we can't do that, but they have historically outperformed the market. Let me stop and say, remember the thing that every investment advisor will tell you, that the past performance of an investment is not a guarantee of the future results. So I just want to stop for a brief moment before I go into this a little bit further. Remember that if you've got questions, enter them into the comments and we'll get a chance to talk about them. If not today, we run out of time today, then we'll get back to you directly, or we'll do a particular show where we just talk about the people that watch the show, their questions. Okay, so going on, let's not get too far off track here. We're talking about what Dr. Pancheca found when he was analyzing these managed portfolios. And I'm going to make this just a little bit larger so that you can see what I'm talking about. What you can see in this particular graph is he showed in his study that 83.7% of the time when a portfolio manager had a lot of conviction in particular focus, they outperformed the S&P 500 by 83.7% of the time. And the average overweight, in other words, this is the overperformance over top of the S&P 500, was done 3.67%. So if you find a particular focus, let's say, for example, if you find a portfolio manager like Warren Buffett who has particular conviction, you've got a particular circumstance where the history is working in your favor. And actually, if you look back, I don't have a chart for it today, but if you look at Warren Buffett's history in what he has as far as compared to the S&P 500, he's actually outperformed the S&P 500 pretty consistently since about 2008. Now, will it happen always in the future? No. The idea that Dr. Pancheca used in this study was he was looking at what had happened historically so that he could get an idea of saying, yes, passive funds do this, or yes, active funds do this. But what he is saying is that active funds that have a concentration emphasis do regularly outperform the S&P 500. Now, you might say the S&P 500 or the index, I said that wrong. The index does not have any type of fees that are associated with it. So what he added into his study was an example that showed how fees impacted this and how it works. Let's take a look and see what he did. What he did is he threw in a 0.85% fee. We call it basis points. 85 basis points was thrown into the example. And if you look at the graph that's showing here, it showed that even though that an active fund with a particular concentration, an average active fund with a particular concentration, it outperformed the S&P 500 74.1% of the time, and the average outperformance was 2.82%. That's significant. That shows that if you have funds that have a particular focus or a concentration, then you have a better probability for outperforming the index. Now, I don't want to be misleading and think that and tell you that index funds are not going to have a place, because index funds do have a significant place. I want to take just a minute. I want to read a quote from Dr. Pancheka's study, his paper, and I think you'll get the idea of what I'm talking about. This is a direct quote from his paper that was done just recently in 2019. He said, large blend active managers have outperformed the S&P 500 in only 5 of 29 years analyzed. On average, active managers underperformed by negative 1.7% per calendar year. Okay, so what's that mean? What that translates into is that if you have a large blended fund, let's imagine whatever name of company that you want, a large blended stock mutual fund, that fund is generally not going to outperform the index. And remember also, I'm going to just remind you, this is not advice. This is just education. I'm telling you about what's happened historically, not what you should do. The only way that you can do that is how? By going to my website at richardsfinancialplanning.com and finding a time to talk to me. And then we can talk about your situation. But in this particular situation, what Dr. Pancheka is showing is that large blended funds on a regular basis underperform the S&P 500. On the other side, when do managed funds outperform the S&P 500? Well, when they have a particular concentration, maybe like a manager like a Warren Buffett. Another particular place that concentration in the past year has done pretty well against the S&P 500 has been in ESG, or environmental, social, and governance focused funds. That's not always going to happen. We can't predict what's going to go on in the future, but that gives you a pretty good idea of the best places to look at utilizing active funds and managed funds. And also, let's take just a quick second and talk just a little bit more about the direct indexing idea. Direct indexing will utilize all those things that we talked about previously. As far as being able to selectively pick stocks that are associated with your index. But there is a concept with direct indexing that's called smart beta. Smart beta utilizes analysis very much the way that football picks its quarterbacks. And this is the idea that I want to get across to you. Now, this year is a little different, obviously, with the coronavirus. We don't have football the way that it used to be. But if you have 4 preseason games, which is usually what football teams do, NFL teams will have, the coach is looking at which players are going to excel and which ones he's not going to use. Let's imagine that a coach was looking for a quarterback, and he had 4 quarterbacks, and he was going to play one in each game of the preseason games. What's he going to be looking for? At the end of those 4 games, those preseason games, he's going to be looking at this. He's going to be looking at, number 1, the attempted passes and completions. He's going to look at the average yards completed per pass. He's going to look at the number of touchdowns. He's going to look at the number of interceptions. And the quarterback that has the best statistics is going to get the job. That's the same way that smart beta works with index investing. You might not want to own all 500 of the S&P 500. You certainly might not want to own all 2,000 of the Russell 2000. But let's say, for example, that you selectively analyze just the statistics. You're not trying to outguess the market from the standpoint of an active manager, but you're just looking at the historical perspective of the stocks that are associated with it. That's what smart beta does. Smart beta takes the portfolio managers guessing out of the game and looks specifically at statistics. I want to show you a little bit more, and then we're going to wrap it up for today. Smart beta will filter out less desirable stocks. It'll emphasize stocks with predetermined characteristics. Characteristics like economic characteristics. It might be just companies that are of a certain size, either small or large. It might be those that are risk oriented. In other words, those that have less volatility, may have less what we call standard deviation. Also, you may look at it from the standpoint of principle based. We talked about this just a little bit. It might be based on the fact that the company is biblically oriented. That might be a stock that you want to include, or that might be a stock that you want to exclude, or it might be a company that you want to exclude that has a history of using animal testing if you're vegan. Those are particular focuses that you can use the smart beta technique and filter those out and still own the index. Okay. That's been a whole lot of information that I have been able to give to you today. And I want to thank you a whole lot for taking your time out and watching the video today. If you have any questions and you didn't have a chance to listen to this during the live broadcast, just enter them into the comments. And if you're listening to this on YouTube, hit the subscribe button so you'll get notified the next time that we have a live stream, or you get notified the next time that we have more information that is put out there for you to use for your investment strategies. The whole idea that we have behind us and behind what I do is to help you find a way to retire and stretch your money and not run out of money during retirement. So with that, I'm going to end for today and see you later on in the week, or see you later on next week, next Tuesday at 11 o'clock. Have a great week.